Welcome to today's Daily Brief. If you've been watching the markets lately, you've probably seen a sea of red in the tech sector. It's super easy to let those flashy headlines convince you that the sky is literally falling. But in this explainer, we're going to tune out the panic and look strictly at the hard data to figure out what this semiconductor volatility actually means for your portfolio and the broader global economy. Let's get right into it. Here is how we're going to break things down today. First, we'll look at exhaustion versus energy accumulation. Then, we'll stress test some semiconductor stocks, examine the broader market reality, review the global macro factors involving China and Iran, and finally, deliver our 2026 market outlook. All right, part one, exhaustion or energy accumulation. So let's kick things off by looking at the recent pretty steep drops in the South Korean Kospi and the broader semiconductor index. This is where the panic has been the absolute loudest, right? So it's exactly where our investigation needs to begin. We really have to ask ourselves, are we witnessing the catastrophic end of this massive AI-driven bull run? Or is the market simply accumulating combustible energy for its next big breakout? You know, when major indices drop, the amateur reaction is pure fear. But the professional reaction? It's curiosity. We need to figure out if the fuel tank is actually empty or if the market just pulled over to the gas station to refuel. To get a real answer here, we need to ground our perspective. We have to compare today's massive AI investments to historical systemic bubbles. Think the railroad rush, the radio boom, or the dot-com era. When we study those periods, it becomes super clear that transformational technology always experiences these massive run-ups, followed by, frankly, terrifying pullbacks. But here's the kicker. The underlying infrastructure investments in those historical examples didn't just vanish into thin air. They literally became the foundation of the modern world. So the question we face right now is, are we in a full collapse, or is this just a structural reset?
Moving on to part two, stress testing semiconductor stocks.
Let's start our micro-investigation by stress testing the exact technical indicators of the specific tech funds that are currently bleeding out. We really need to put these charts under a microscope. Take the MTUM ETF, for example. This is a fund packed with high-momentum, large-cap semiconductor stocks. It's surged incredibly from March to June 2026. But now? Well, now it's in a clear bearish correction. This index is a fantastic proxy for all the AI and semiconductor hype. It went on an absolute tear, driven heavily by semiconductor valuations. And yeah, now it's sliding backwards. But remember, a slide doesn't mean a crash if you know exactly where the floor is. Now, what's genuinely fascinating here is that the current pullback to the 287 price zone perfectly aligns with a 0.50 Fibonacci retracement. Okay, what does that mean? It's basically a mathematically healthy halfway floor designed to wash out over-leveraged buyers. This is a totally classic market maneuver. When a stock or an index shoots up way too fast, retail investors tend to jump in with borrowed money, leverage. The market naturally pulls back 50% of that recent gain just to shake those leveraged players out. It's a calculated reset, not a random freefall. And we're seeing an identical footprint over with SK Hynix. They're a major South Korean memory chip manufacturer, and right now the stock is looking for a hard floor around the 1.6 million won mark amidst a weakening won to dollar exchange rate. SK Hynix is essentially a bellwether for the entire semiconductor industry. It kicked off its last major upward wave back in early May, and right now, its price is dropping right back to exactly where that wave started. So why does that matter? The crucial point is that this exact price level represents a 0.618 Fibonacci retracement of its recent run-up. Again, this signals a calculated market reset rather than some panic-driven crash. The math here is just incredibly precise. A 61.8% pullback is considered a golden ratio in technical analysis. It essentially tells us that institutional algorithms are controlling this descent. They're carefully driving the price down to the exact point where they can buy back in at a major discount. Ultimately, when you look at this micro-level data, it reveals that institutions are just doing a routine deep clean of over-leveraged retail positions before deploying new capital. They are literally cleaning house. If you bought on margin at the very top, you're getting swept out right now. But if you're sitting in cash or holding for the long term, you're just watching the market build its next launchpad. All right, section 3, the broader market reality. Having solved the tech pullback mystery, let's zoom out to the broader market to see if the overall American economy actually confirms our thesis. I mean, if the whole economy were crashing, tech wouldn't be falling all by itself, right? For this, we're going to bypass those tech-heavy indices entirely and look directly at the NYSE index. This is a massive collection of nearly 3,000 stocks that provides a much more unmanipulated look at overall economic health. You see, the S&P 500 can be heavily skewed by just a handful of tech giants, but the NYSE index, That is the real economy. We're talking banks, industrials, retail, and healthcare. And this data brilliantly illustrates the truth of what's happening. Despite the localized panic in the tech sector, a staggering 70% of NYSE stocks are quietly trading comfortably above their 200-day moving average. Seriously, just think about that for a second. The headlines are screaming about a tech sell-off, but underneath the surface, 7 out of 10 companies in the broader market are experiencing really strong, sustained uptrends. With the advanced decline line sitting right at historical highs, we basically have conclusive proof that capital isn't fleeing the market in fear. It's just rotating. It's moving out of tech and into other strong sectors. Guys, this is the absolute hallmark of a booming, healthy market. The money isn't being stuffed under a mattress. Investors are simply taking their profits from semiconductors and flowing that capital into undervalued sectors. This kind of broad base of participation is exactly what you want to see if you're a long-term investor. Let's move to Section 4, Global Macro, looking specifically at China and Iran. Now we have to zoom out one final time to the geopolitical landscape to uncover the hidden global catalysts that could ignite the next phase of this market. Because, as we know, markets definitely don't operate in a vacuum. Let's look at China. The government there reports a modest 5% unemployment rate, but actual estimates put the reality at well over 10% due to severely weakening domestic demand. So the official numbers from Beijing are painting a pretty rosy picture, but the on-the-ground reality is one of a rapidly decelerating economy. Domestic consumption is struggling big time, and their economic engine is starting to stall out. Because the Chinese economy is heavily decelerating, the government is inevitably going to be forced to aggressively stimulate domestic consumption. And that move, it's going to send shockwaves of growth across global markets. Historically speaking, whenever China's back is against the wall economically, they open up the floodgates of stimulus. They'll have to print money and incentivize spending. And when the world's second largest economy injects massive liquidity like that, that money inevitably finds its way straight into global equities. Meanwhile, over in the Middle East, the Iranian regime is buckling under the pressure of severe domestic resource shortages. I mean, they're even forcing citizens to turn off their air conditioners in the peak of summer. This kind of extreme domestic pressure could ultimately force a de-escalation in geopolitical conflict. It's incredibly difficult to sustain aggressive foreign posturing when your domestic grid is literally failing. The grim reality of food, medicine, and energy scarcity puts immense pressure on leadership to cool regional tensions and seek some sort of relief. Which brings us to our final section, the 2026 market outlook. Let's bring all these micro, macro, and geopolitical clues together to establish our final verdict for the months ahead. We've got the data, now let's synthesize it into a strategy. Looking at the macro outlook, here's how this builds. As conflicts potentially cool off, global risk premiums will plummet, adding massive fuel to an already fundamentally strong stock market. Just to clarify, the risk premium is essentially the extra return investors demand for putting their money in an uncertain world. If Iran steps back and global tensions ease, that premium drops significantly. And that means equities suddenly become vastly more attractive to major institutional buyers. With AI investments remaining totally solid and the broader market showing quiet strength, all indicators suggest we are in a prime accumulation phase. This is setting us up for a highly robust market throughout late 2026 and into 2027. The AI revolution is far from over. The initial hype cycle is just normalizing. Add in that inevitable Chinese stimulus, a rock-solid NYSE base, and decreasing geopolitical risk, and you have a perfect recipe for significant upward momentum. So, I'll leave you with this final thought for your own portfolio strategy. As the rest of the crowd panics over completely normal mathematical retracements, will you have the clarity to see the market simply refueling for its next great leap? The data tells a story not of a crash, but of a deep clean and a profound opportunity. Thank you so much for joining me for this explainer, and I'll catch you in the next one.